Alright, for this video tutorial, we're going to go over a sample Form 1120 corporate tax return for the 2022 tax year. And the fact pattern that we'll be working with is for a lawn care business. So I've covered this fact pattern before in two previous videos, one where we had a partnership return, and then the second one was an 1120S for an S corporation. And so now we've got the same kind of fact pattern roughly, but we're filing a corporate return instead. So what would it look like if the owner set up a corporation taxed as a C Corp instead of those previous two tax structures? So similar to the previous videos, we've got slides in front of us here covering all the elements that we're going to walk through. Another slide, slide number 2, covering the fact pattern itself. And then like the other ones, we've also got the financial statements. So I've got a cap table here for the company. We've got the financial statements for the business. So this is going to be Fake Lawncare Business, Inc. Profit and loss on the left here, balance sheet here on the right-hand side. And then we've got a kind of a book-to-tax reconciliation here showing how some of these changes are made on the tax return. And then lastly, of course, we've got the return itself. So here's our sample Form 1120, 2022 tax year for Fake Lawncare Business, Inc. And so, of course, we'll get into this in more detail as we move on through the video. So going back to the slides to start here, just want to cover everything that we've got, kind of give us a high level before we get into the details. So we are covering an 1120 tutorial, and this is for a newly formed entity. And that's relevant because if the entity existed in the prior period, then we would have some carryover information, right? But this is a new company formed in the 2022 calendar year. Go over the financial statements and then the tax return itself, right? So pages 1 through 6 of the Form 1120, certainly kind of like the standard set. You always do those. And then we've got some additional ones. So the 1125A for cost of goods sold. Depreciation for newly and existing, if this was a second year assets, we have a 4562 for the depreciation. Schedule G is a disclosure of the owners of the company. So if you have an owner that owns a certain amount of percentage, they might have to report that additional information on Schedule G. Now, bonus depreciation, so 2022 assets placed into service could qualify for up to 100%. That obviously changes in 2023 and going forward because there are some new phase-outs under the Tax Cuts and Jobs Act. We'll also get into the Form 4136, so credit for federal fuel taxes paid, right? And this is a refundable tax credit for the corporation. And then we'll also look at the work opportunity tax credit. So that's on Form 5884, and that is a non-refundable tax credit. And so you'll see the distinction, a key distinction between these two, because the company will be in a net operating loss position, and so it'll change how we kind of account for these credits in the current period. Form 3800 is the general business credit form. This has to be completed along with the work opportunity credit, and it's also important because it's what we use to document the carryover of our unused non-refundable credits. We'll also talk briefly about the dividend received deduction. So corporations get a DRD depending on how much of the stock they own. We'll talk about DeMinimis safe harbor elections. So small equipment purchases, improvements. Often you can just write those off or expense them currently rather than have to capitalize and either depreciate or amortize those costs. And then lastly, we'll talk about a Section 351 statement. So when a corporation issues new stock in exchange for property, that includes cash, mostly that's the case, they should be including a 351 statement, and or the new shareholders should be attaching a similar statement to their return. So we'll look at that as well. All right, so I want to go through the fact pattern really quickly here, and then we'll briefly look at the financials and then start getting into the return. So the fact pattern we've got here, we've got John Smith and Jane Doe. Their friends decide to partner up and open a landscaping and lawn care business, right? So they're each going to own 50% of the company, but only John is going to be actively participating in the business. So Jane is going to be involved, but more kind of like a board member type role where she'll consult with John a little bit here and there, but he's going to be the one that's in the weeds, so to speak, actually running the business. And so he's going to be paid a salary of just $5,000 for the first year. So obviously a very nominal amount, but they've kind of figured out, well, the company's a startup, we're not making a lot of money, so we're going to save the money for wages for our other employees, and then I'm only going to get paid this small amount. So the corporation issues 1,000 shares. So if we look at the corporate charter, it's $1 par value common stock. 1,000 shares are issued, 500 shares to each shareholder. And in exchange for that, John and Jane put in $10,000 each. And there's no dividend distributions during 2022. So they just put money into the business. Now, during the year, the corporation purchased some property, so the mowers, truck, and trailer, and they financed the purchases. And those purchases are going to be eligible for that bonus depreciation, so we'll take that. Now, also during the year, John opened a brokerage account under the company name and tax ID. And so there was some interest income and dividend income earned on that account. And then John also hired a part-time admin person through Florida's Work Opportunity Tax Credit Program. And the reason this is significant, because if you hire employees through these programs and they qualify, you might get a tax credit for a percentage of the wages paid to that employee. And so that's what we have here as the Work Opportunity Tax Credit that's going to go on the 5884. Now, the federal fuel tax credit on the 4136, so that's relevant here. So the company tracked the number of gallons purchased for use in the lawnmowers, and this is off-highway use, federal fuel tax credit. And John and Jane determined they're going to be eligible, so they reported 4,206 gallons of non-dyed fuel. So that's important too, right? Because if you purchase the dyed fuels, those are generally exempt from the tax at source, right? So you can't get a tax credit unless the tax was actually imposed. And so if you use non-dyed fuel, then the federal tax is likely included. Now, the company also purchased some small tools and equipment, right, for use in running the business, and they decided to deduct those currently, and that's going to be the DeMinimis safe harbor election. All right, so if we look at the financial statements really quickly here, I want to go through these briefly, and then we'll start keying everything into the return. So on the left-hand side, we've got the profit and loss, so revenue from sales, right? So sales and services provided to customers. Cost of goods sold, these aren't inventoried costs, but they're still cost of goods sold directly related to the services provided. So we've got things like the direct labor, materials and supplies, fuel costs, and so on. Expenses down here, right? Expenses running the business. The depreciation expense, notice on the balance sheet here, the total costs of the mowers and truck and trailers, that all added up to $73,500. And because they got a 100% bonus depreciation to write it all off, we see here the accumulated depreciation is the same amount. Now, for book purposes, they've decided to just get it to match the federal depreciation schedule for tax purposes, which is fine. They can do that for book purposes. But if you have a company that uses, let's say, US GAAP, well, GAAP has different depreciation methods, so you wouldn't see a full write-off in the current year. And so if that's the case, then you might have a book tax adjustment for the depreciation, but in our case here, they're not going to. Okay? And then further on with the balance sheet, nothing too complicated, right? Checking account and savings account, a security deposit on some rents or facilities expense, let's say. There's the brokerage account balance, the mowers, trucks, and trailers that were purchased. There's those costs for the year. On the liability section, they've got some accounts payable, payroll liabilities, credit card accounts, and then there are the ending or the balances owed on the finance purchases for the mowers, and then the F-250 they bought. Those are the outstanding loan balances at the end of the year. And then the equity section, capital stock representing the shares issued at par, and then any excess contributions over par are treated as additional paid-in capital. And so that's why we have those line items there. All right, so let's look at the return now and start entering some of this information. So the 1120, a good place to start, obviously, is at the top with all the information on the entity itself. So name, address, Employer identification number is the tax ID, so the EIN for the company. Date the company was incorporated, and then up here at the top, we've indicated that because this company was set up on Jan 18th, it didn't exist for a full calendar year. So we've put in January 18th, 2022 through December 31st, 2022. That's the period for the current tax year. So it's referred to as a short period return. Next good place to start is in page 4, Schedule K. Information on the return and the company itself. So this is also kind of a good next place to go, because a lot of yes or no questions here will determine or drive kind of other elements of the return that you might need to complete, or pieces that you can just leave blank or just ignore. So Schedule K, accounting method, we are operating on the accrual method. Business activity code, product or service, all that's entered. Question 4, it's asking us information on the owners. So we have indicated yes here for 4B, because it's asking, did any individual own directly 20% or more, directly or indirectly 50% or more of the total voting power of the stock? And in our case, yes, right? So John and Jane each own 50. So because they each own 50, we have to list both of them on Schedule G. So we have included a Schedule G, and we inputted their information there. The rest of these questions down on here are no. It is asking us on line 10, right? Enter the number of shareholders at the end of the year if we had 100 or fewer. In our case, yes, we are under 100, so we've entered 2 there, right? We do have 2 shareholders during the year. Some other information down here. Question 13, are the total receipts for the year and assets less than 250? In our case, yes. And so this question, even though we answer it yes, we are going to go ahead and complete Schedules L, M1, and M2 anyway. And I like to do that just because it provides a more complete return. I think it's easier for the user of the financial statements and the return just to be able to see everything on there. So we'll do a little extra work, and we'll go ahead and complete these pieces. It is asking us here in 15A and B if we did 1099s, and we did. So we had 1099 NECs issued to the contractors, so we've gone ahead and done those. And then all the other questions down here are just no, and that's just given our fact pattern is relatively straightforward. And so all no's there, but of course, read each question carefully, make sure you understand it, and answer yes or no accordingly. And then Schedule L is going to be the balance sheet per books, right? So Schedule L, at the start, beginning of the year, we don't have any information, and that's because this is a new company, right? If it's set up in the current year, you're not going to have beginning of year balances. So we have our end of the year balances here. So if we look at our financial statements, basically we're just transferring all of these amounts over to the appropriate line items on the Schedule L. So the cash, accounts payable, the notes payable. So if I take a look here, there's our cash balance. I've added here on other current assets. So that's the brokerage account plus the security deposit. We got our accounts payable there, 801, other liabilities. Mortgages, notes, bonds payable 1 year or more, right? Those are the financed notes for the mowers and the F-250, the truck they purchased. And then, of course, down here in the capital stock and APIC section, we've got our $1,000 of common shares and our additional paid in capital amounts. And then the retained earnings, and we'll see this after we look at our book income and Schedule M1, but that is the loss. That's the book loss that we have for the year. So remember, retained earnings, we get a reconciliation in Schedule M2. And so retained earnings is effectively beginning of year retained earnings plus or minus any net income or loss per books. And then it's reduced by any dividend distributions, right? So in contrast, what we see with, let's say like a Form 1065 partnership return, that roll forward of partner capital, it goes up or down based on not only the net income or loss per books, but if you contribute capital, that's an addition to it. If you take capital out, that's a distribution or a reduction. But when we talk about corporations and a retained earnings roll forward, it's increased or decreased depending on whether you have net income or losses per books. And then it's generally the only reduction, apart from some other unique pieces, is a dividend distribution, right? You don't increase retained earnings by capital contributions. So that's why we don't see any entries down here for capital stock or additional paid-in capital amounts. Now, the buildings and other depreciable assets, so if we have a look at our depreciation schedule, we'll see that we added the $73,500 in fixed asset purchases. So that's the F-250, the trailer, the mowers, and then we are taking bonus depreciation for the full amount. So if I go ahead and let me jump down to the 4562 so we can have a look at that. So 4562, pages 1 and 2 are where we enter all the information here. Part 2 covers special depreciation allowance, right, for qualified property. Now, we also have to do a separate entry for listed property. So listed property are effectively things like vehicles, right? So the reason we don't see the full 70,000 plus there is because this is the portion that's not attributed to the listed property. When we depreciate fully listed property, it has to be separately stated in Part 5. So Part 5 here, we've got listed property. That's the truck. So it's a passenger automobile. Well, no, it's an automobile driven by persons that's on the highway, but it actually doesn't really qualify as a passenger automobile because it's over the gross vehicle weight. But it's still eligible for bonus depreciation. So we've got our listed property here, right? Certain automobiles. We've listed the F-250 here. Our business use is going to be 100%, right? None of the owners or employees drive this for personal reasons or commuting. It's really just used to haul around the mowers, right, and the trailer. So the cost basis there, $44,850, and then the special depreciation allowance, the full amount of the deduction is going to be 100% of the cost. So that's why we have our $44,850 there. We have indicated here that our business investment use, yes, we do have evidence to support that. And in 24B, the evidence is written. And then because we have a vehicle up here in Section A, we do have to provide more information on the mileage driven, right? So Section B's information on use of vehicles, this must be completed if the owner, so more than 5% owner is using it for the business as well. So we've entered the total miles driven. Let's say in this fact pattern, we're 52,600 for the year. No additional, no to the answer to the question here, right on, was the vehicle available for personal use off-duty hours? No, right? So this vehicle really is just used for business, right? John and Jane don't drive it for personal reasons whatsoever. So we've answered no, and then yes there. All right. Now, again, when we have the 44,850, that depreciation deduction is flowing up here to Part 4, line 21. And then the bonus depreciation taken on everything else, the trailer and the 2 mowers, that can simply be reported here on line 14. So the aggregate, $73,500, that's the total depreciation, bonus depreciation for the period. And so that's why we see a full amount of depreciation being taken, $73,500. So it basically wipes out the total asset value for tax purposes, that is. Now remember, this is balance sheet per books, right? So if you had a set of U.S. GAAP financials that didn't match it for tax purposes, then you would use your U.S. GAAP financials here, and you would just have a book tax adjustment for the variance between the book depreciation and then the tax depreciation. All right, so I'm going to go back to page 1, and we'll start entering some of the information for the profit and loss, right, for the business. So if we quickly glance back at the profit and loss for the company, so we've got our revenue, our cost of goods sold figures there, and then all the related expenses that need to go into play. So relatively straightforward with corporations, right? So unlike pass-through entities, all of the income is for the most part just aggregated and reported on line 1, right? We don't have to separately state items like dividends and interest, rents, royalties, right? If you're familiar with the Form 1065 and the 1120S, page 1 is just that ordinary trade or business income, and then Schedule K, you report all these other items. Doesn't work that way with corporations, right? If a corporation earns dividends or interest income, report it all here on page 1. So we've got the revenues, we've got our cost of goods sold item there, including a Form 1125A to report all the cost of goods sold items. Our dividend income is $40. Our interest income was $10. So there's our total income. And then on lines 12 through 28 down here, we're reporting all the expenses. So officer wages there for John, other salaries and wages, repairs and maintenance expenses, taxes, licenses, and so on. Right there on 4562, we can see the bonus depreciation, that amount 73,500, and then all the other deductions are reported on line 26. Now, the salaries and wages amount, notice it's $22,620. If I look at the financial statements here, that number is different, right? So our staff wages were $25,500, yet when we look at the tax return for tax purposes, we're deducting $22,620. So there's a variance there of about $3,000. Why is that? That's because of the work opportunity tax credit. So if I look at the book tax reconciliation here, this will show kind of a side-by-side. So the book income or expense is on the left-hand side here. So this matches exactly what we have on our financial statements. And here's what I have being reported on page 1 of the Form 1120, so what we were just looking at. Now the variance here on the admin staff wages is $2,880. The reason this is included, because when we take a work opportunity tax credit, you have to reduce the amount of your expense by the amount of the credit, right? And that is done because you're not supposed to, get the benefit twice, right? So it'd be kind of double dipping if you got a tax credit and we're able to deduct the full amount at the same time. So we have a book tax adjustment here because we'll be claiming a $2,880 tax credit under the work opportunity tax credit rules. So if we want to quickly look at that, let's go to the 5884 work opportunity tax credit. That's the credit on fuel taxes paid. We'll come back to that. All right, so here's the work opportunity tax credit form. Now, you recall an individual was hired to work as an admin person, and the total amount of hours that they paid them over the course of the period were not hours. Right? They worked them over 400 hours, so they got over 400 hours of work during the period. So the amount of wages that they were paid is being reported here on line 1B. So $7,200 in wages were paid to this employee. The employee worked at least 400 hours during the year, and it's their first year working with the company. So the amount of wages is reported here on 1B, and the amount of credit available is $2,880, right? So remember, that's the amount of the credit. So that is a non-refundable credit, so it's a dollar-for-dollar reduction in any taxes owed. And it is reported down here on line 4, and then it's also reported on Form 3800. So 3800 is the general business credit form that's included with the tax return. And that, if we look at that, what you'll see is that the general business credit form compiles a lot of different kind of credits. So if we look at page 3 of the form first, so page 3, part 3 is where we initially report these amounts. So it's a general business credit from a non-passive activity, and you can see all the different types of credits that we have here. The one that's applicable to us is going to be reported here on line 4B as the work opportunity tax credit form 5884, and there's the $2,880 amount. Now, the $2,880 amount, this is where you would report all of these credits from these varying activities. So you'll notice, there's a lot of them here. In our case, we've only got the one credit, so we don't have to complete all these other relevant forms. But we've got the 2880, and then ultimately that's flowing up here to page 2 of the 3800, where we compute the allowable portion of the credit. So what do we mean by that? Well, the credit is subject to certain phase-outs, right? Namely, a tax liability one. In our case, what we'll see is that because the company has zero taxes owed, they're still eligible for the credit, but they're not going to be able to utilize it in the current period, right? So it's going to have to be carried over to future tax years and use then. So if we look at Schedule J of the return, so let me go to page 2. Okay, so Schedule J is where we compute the amount of taxes that are owed or that the corporation is liable for, and then we account for any kind of credits. So if we quickly look at page 1, notice at the bottom here, the taxable income is negative. So we'll go through some of these elements down here in a little more detail in a bit, namely the dividend received deduction and the federal fuel tax credit. But notice the taxable income is negative $54,000 because they're in a net operating loss position, and total taxes is 0. And so those numbers are pulling from Schedule J. Now, because total taxes are 0, you don't get to claim non-refundable credits like the work opportunity tax credit. And so that's why the 3800 is reporting a 0 amount of credit used, and there should be a carry forward schedule where we, okay, so here's our carry forward schedule for unused general business tax credits. So the schedule we have at the bottom here shows the 5884 work opportunity credit. The current year amount, so the original credit amount, $2,880. The credit allowed is 0. Carrybacks to the prior period aren't going to apply. And the carryover to 2023 is going to be $2,880. So the full amount of the credit is being carried forward. And that's important, right? Because if you claim these credits, you want to make sure that, if you can't get to use them in the current period, make sure you're properly tracking them year to year so you don't lose out on them. I see far too often a lot of companies forget to track their carryovers, and then they just completely miss out on these credits. Okay, so talked about those credit carryovers. Now let's go to, I want to go to the federal fuel tax credit. So remember, they tracked obviously they make fuel purchases. So if we look at their financial statements here, they make fuel purchases for the trucks themselves, right, driving the F-250 around, but obviously they also have fuel costs for the mowers. If you purchase fuel, and so it's the non-dyed fuel that has the federal taxes imposed on a per gallon basis, if you have any qualified non-highway use, you might be eligible for a tax credit based on the amount of gallons you purchase and use in the business. So if we look at the return here, all of this is claimed on the Form 4136. And so the relevant section for us here is in Section 1. So it's non-taxable use of gasoline, off-highway business use, and the reimbursement rate is 0.183 cents per gallon. So the business had 4,206 gallons used. The amount of credit available is going to be $770. Now, this is a refundable tax credit. Okay, and so you notice how differently this is being treated on the return. So if I look at Schedule J here, so again, Part 1, tax computation is 0, right? So we don't have any taxes that are going to be imposed, nor do we have any non-refundable credits to claim because we don't have any taxes. So if, for example, we had taxes owed, that work opportunity tax credit, we would see something flow through here to line 5C, right? Our general business credit attached 3,800. But see here, it's just 0 because we don't have any taxes, so we can't claim any non-refundable credits. Different rules for refundable credits and other payments. So refundable credits and payments can be realized even if you don't have federal taxes owed. And that's what's going on down here on line 20. So on line 20, we have refundable tax credits flowing through from Form 4136. That's a federal fuel tax credit for $770. So we are actually going to get a refund check for $770 because that represents the amount of tax we in effect overpaid when we were purchasing all that fuel for use in the mowers. So even though taxable income is 0, we didn't make any actual payments, no estimated payments, there's no withholding taxes. We still get credit for the fuel taxes paid on those eligible gallons purchased. And so the company will actually get a $770 refund check for that purpose. All right, so now let's have a talk about the Schedule C, so dividend received deductions. So because corporations have that double layer of tax, there are special deductions allowed for payments of dividends and other kind of eligible items. So the way the dividend received deduction works is if you receive a dividend payment from a C corporation, the dividend is included in your income, right? It's included in your income, included in book income, but you might get a deduction based on the amount of stock you own in that eligible company that paid you the dividend. So in our case, remember, we received $40 of dividend payments from domestic corporations, right? So that was just a stock that John invested in through the brokerage account. And the amount of stock that he owned is less than 20%. So let's say that John purchased stock in Apple, and Apple paid a dividend of $40 to him. Well, he certainly owns less than 20% of Apple, right? He's, a nominal shareholder. And so because the amount of stock owned in Apple is under 20%, he reports the dividend amounts up here on line 1, and he gets a dividend received deduction of 50%, so it's going to be $20. If you own a lot of a company, so wholly owned, or if you own 20% or more, notice how the rate increases, right? So if you own 20% or more of a domestic corporation, so let's say you have a subsidiary entity that you own a significant portion of, you'll get a 65% dividend received deduction instead of a 50% dividend received deduction. Now, if you have wholly owned subsidiaries, right? So wholly owned foreign subsidiaries get a 100% DRD, and affiliated group members. So those would also be your, a wholly owned subsidiary, for example. You get 100% dividend received deduction. So you're still recorded in your income, right? Because it's a dividend passing up from a subsidiary. But when you compute your taxable income, you would get a DRD for the full amount if that was the case. But in our case, we get a 50% DRD. So it's something, right? So we've got the $20, so that's 50% of our dividend income. That's going to be the DRD. And so you'll see here that the taxable income drops again by $20. So $53,980 is our taxable loss before factoring in any special deductions or NOLs. Tack on the extra 20 exclusion, and now we're down $20 lower to $54,000 loss. All right, so next I want to talk about the Section 351 statements. So if I scroll through here, let me find the election statement. It's our depreciation, credit for fuel taxes, work opportunity credits. All right, should be in our supporting statements. Okay, so this statement pursuant to Treasury Regs 1.351-3B. What is this? Well, a Section 351 statement is generally required when a shareholder transfers property to a corporation in exchange for stock. Now, under 351, it's generally a non-recognition event. It means that there's no tax liability or taxable inclusion whatsoever for both the company and the shareholder, but you have to attach a statement to that effect. And so this is a very simple 351 statement. It includes information on the shareholders, right? So John and Jane, their tax ID numbers, the date they made the contribution, the type of contribution made, the property was cash, their basis, and the FMV in the property. When you make cash contributions, obviously those numbers are going to be the same because cash is, FMV is just whatever the cash value is, right? So basis and FMV are going to be the same. And so as long as you include that in the statement, then the non-recognition should apply, and you've complied with the regulations. The last election statement that we've got here is the DeMinimis safe harbor election. So recall on the financial statements we had I noted here the DeMinimis safe harbor election. So purchases for some computer equipment, tools and other equipment, repairs and maintenance expense. So when you purchase, these are assets in a sense, right? A computer is going to last more than a year, hopefully, right? But if you purchase equipment or tools that last generally longer than a year, arguably you should capitalize these and depreciate them. But there are these de minimis safe harbor rules that say, look, if you have these small equipment purchases, you can just expense them immediately, right? So just as ordinary and necessary expense under Section 162 go ahead and just write them off when you purchase them. You don't have to add them to your depreciation schedule on your balance sheet. But in order to be able to do that, the amounts have to be below the relevant thresholds. You have to have an accounting policy in place to do this, and the company does, of course. And then the last bit of work that you need to do is attach the de minimis safe harbor election, right? And so the company has done that here. And last but not least, talk a little bit about the NOL, right? So this is an NOL worksheet. So if we go back up to page 1, recall here we had the $54,000 in taxable loss for the year. This is our NOL amount. So the losses for corporations can be carried forward, right, and applied against future taxable income. So in our case here, we've got our NOL of $54,000, and this is a worksheet that, as you can see here, the page is not filed with the return. It is only for our records, and that's true. So there are some bizarre rules that the IRS has, and one of which I think is kind of strange is, they don't want a roll forward. They don't want to see a roll forward record of the NOLs, right? We track this ourselves internally and then report everything appropriately on the tax return. So that's why it says, don't file this return, just keep it for our records. But that's what we're going to do, right? So we've got our NOL worksheet. The worksheet is broken out into a number of columns, right? So it shows the amount of the loss for the period, how much is being applied, what's unused. And so in our case here, we have the current year NOL of $54,000. This is the remaining NOL carryover is the full amount, right? So we haven't had any roll back to prior years. We haven't had any applied to the current period. And so for this reason, the full amount of $54,000 is just going to roll forward to next year. And so we'll figure out, whether we can use any of that in 2023. All right. Okay, I think that covers it for this tutorial. Let me go back and just make sure I covered all these pieces, right? So we talked about bonus depreciation, went over all the taxes, the tax credits, DRD, safe harbor, the Section 351 statement, covered the NOLs. So I think that that does in fact cover it for this video. I hope this was helpful. For this business, this fact pattern, go check out the other videos I did on the partnership return and the 1120S, right? It's very similar fact pattern, similar numbers, but obviously the reporting is different, right? Because it's not a corporate entity in those videos. It's either a partnership or an S Corp. So that covers it. Thanks so much for watching. Hope it was helpful. If you have any questions, leave me a comment below, and I look forward to seeing you again on the next video. Thank you.